Okay.
Let me first do that introduction here. So, hey, welcome everyone. Today is Saturday, September 23, 2023, I guess. Yeah, 2023. And it's the first day of fall, is it? Is it the first day of fall or is it the
Yeah, it
first day of...
is.
It is. So happy fall, if that's a thing.
Mhm.
We're on the home line, home stretch for 2023. So hopefully everything is going well for you, maintaining good discipline, saving that dollar, making sure that you're protecting it. Stop loss, remember, is not an option. So we're going to talk about options today and other things as they come along, everything about money and trading in the stock exchange. So right now, Michelle is telling us about how she trades for 20 cents, and we're saying that's a no, we don't do that. So let's just describe that scenario. For instance, right now S&P is trading at what, 43.20, right? So Michelle, would you buy a CCS over here, or I mean, would you sell a CCS or sell a PCS? What would you do?
I would do a call.
A
I would sell
call,
a call
a
because
CCS,
it's
right?
going down.
Because it's going down, and even if it's going up, we don't think it's going to go up 80 points. So would somewhere over 4,400 be a safe place?
Yeah.
Yeah, because there's a gap over here, right? There's a gap. So, folks, what we're talking about is we're taking advantage of prices falling, uh, market direction, momentum going down or supporting the underlying going downwards. So, what we do is one of two things, or one of several things that we could do. We could buy a put to take advantage. That's one simple strategy. But if we do that, well, not a bet, but if we do that, obviously our exposure is extremely high because we want to do maybe 14 to 21 days on S&P. Let's say October 9, right? If we just buy one put, that would cost us roughly about $5,000 or 50 points, 50.50. So that's slightly over, actually in the money would be 5,200. So that's not a good deal for a small account. It's a lot of risk. It's a lot of risk. So instead, what we would do is we would,
Eddie,
yeah.
I just joined. Are you just showing your screen? I don't see it. I only see your desktop background.
Let me see. You only should. Okay, well, let me fix that. Let me see. I thought I was sharing. Is anybody else seeing?
No. Now we
Okay.
see it.
Now we see
Now we
it.
can see it.
Oh, okay. Sorry about that.
Now we can see it.
Awesome. Thanks, Mary, for sharing that. Yeah, I thought I was. I should have done a check. But anyhow, we talked about that. S&P and strategizing how we take advantage of further price movement to the downside. Yeah. So simply, somebody who's not approved for verticals would just simply buy a put. We saw that if you went 16 days out, you'd be spending roughly 5,200 on a single put. That's a lot of money, a lot of exposure. So a different way, obviously, would be to sell a call. Now, we know we can't sell a call naked, so that's why we do, sell a call, buy a call, and we call it a credit spread. Yeah, just to collect some premium. So here, the principle is we're selling where we think price is not going to go. And I'm looking at about 4,400, which is on the other side of the gap. The gap is actually all the way to 44.01, but 4,400 is good enough for us. Assuming today is Monday and the market is open, I'd simply go over to 4,400. Where is that? 43. Maybe I need more strikes. Let's try that. Let's try 30. How about that? I need more than that. All right. Okay. Let's go 50. What am I doing here? I'm just increasing the number of strikes that I see on my screen. That's what I'm doing. Yeah. And I don't really want to show all because that pulls in a lot of data unnecessarily. So I just see that. This is the long way to do it. So what I would do is I would sell the 10 or the 4,400 for 10 cents, and I would buy something further away, which is 44.05, to make that a vertical. And you can see there's only 10 cents in there. That's not good. I don't think it's even legit. I wouldn't recommend that. So instead, what we would do is go a little bit closer to the fire. And let's define what the fire is. The fire is at the money. Yeah. So the better thing to do here would be to maybe count about 6 or so strikes away from that. I'm going to move, by the way, from spread single to vertical to make it a little easier. And that way we can also count 1, 2, 3, 4, 5, and 6. And maybe in the 7th one at the 55 is probably where I want to be messing with. You with me so far on that? Around the 35, 43.55, 43.60. Let's take a look and see what that is. There's 90 cents at the moment. 90 cents at that point. But what is the risk here? 43.55, 43.60. We're saying that we don't expect price to go all the way up to 43.55. And if it does, it's going to trend below. Well, let's see what's at 43.55. So I'm just going to say here is a target of -1. We're shorting 1 there, 4355. Let's give a nice dashed line. So that's dangerously close. Would you say that?
Yeah.
Yeah, that's too much risk. The only way that you would do that is if you had full faith and confidence that it is not going to try and go upwards, because that's only 5 minus 2, 30 points away, right? 35 points away from the money. And that's just too close. If you're risk averse, then you at least want to be in the gap, if not away from the gap. So how about we go up to 75? Let's see where that is. So what that gives us, 75 would 75.80. All right, Michelle. Then this is what I would do. 35 is still low. This assumes that you're going to let these expire so that you can collect the full 35.
Mm-hmm.
Yeah.
Yeah.
But knowing you and what you said, that you're risk averse, then it's still not a good deal, because with S&P, that 50 points is nothing really.
Yeah.
Yeah, it's nothing. It can do that in 20 seconds flat.
Yeah.
And the ATR over the last 14 days has been 40. So the way to evaluate where to sell is when the market is open. When the market is open is the best time. You will have key pieces of information. First and foremost, you will have the true IV, which is that number we see at the top right of your Thinkorswim, the implied volatility. So right now we're seeing that for 25 September, which is Monday, it's approximately 35 plus or minus. So it could swing up 35 or down 35, or a combination of those two things. So you need to be at least 35 away from where the current price is. 35 plus 20 is 55. So you can see that 75 is still over where we are, but there's really no money. Yeah, there's really no money. So you want this to guide you. One other thing that should guide you is what the ATR is, which is right now standing at 40. S&P, we've known ATR to go maybe even 90. We've seen it go 30. We've seen it go 60, all that. But over the last 14 days, it's been 40, right? So this is also guiding us and telling us that when the market is open, right at the open, what is that number? What is that IV number? And then use those two numbers to help you decide where you think price is going to range. And then based on that, add another 10 or 15 points.
Okay.
The reason I say 10 or 15 points is because when you're within 15 points of the current price, that's a dangerous situation. That's extremely dangerous situation. It means, first and foremost, your theta is not decaying as quickly as it should.
Okay.
Right? As quickly as it should. More than 15 or 20 points from the current price, theta is working for you beautifully. right? Especially even if price is not moving, then that's a good thing for you. It means that your theta can decay that premium from $1 to 20 cents in a matter of 20-30 minutes. That's how aggressive it is.
Okay.
That's how aggressive it is. So I think it's a much better option once you figure out what the direction is, which is hard to do, right? I admit. But once you figure out that direction, then what you're going to do is sell, and you're going to have to do this early in the morning and be in the trade about, plan to be in the trade about 30 minutes or less. If you're still inside the trade for 1 hour, you're probably losing money at that point.
Okay.
Yeah, that's the nature of credit spreads, whether it's a put credit spread or a call credit spread. If you're inside of the trade for an hour and a half, it's usually not a good sign. You should be looking, how to get out.
Okay.
But let's also talk about stop loss. So your stop loss should be, you understand how to do stop loss on spreads?
I don't do stop losses. I just sit there and watch the screen.
Man, you're killing me. Yeah. All right. Stop loss. You have to have a stop loss. And let's say you pick up 70 cents credit. Yeah. 70 cents credit. And you said you normally would do, say, about 5. So what if I proposed to you that you're looking for that $350 if you pick up 70 cents, yes? And assuming that things go your way, then you would close, say, about 10 cents. Yeah. So you would net about 60 cents because you're trying to make your $300. Right? 60 times 5 is 300.
Okay.
What if we decided that the total risk here initially would be, the total risk would be 5, because this is a 5-point spread, minus 70. You with me on that so far?
Okay.
So that's the maximum loss. So the maximum loss on a credit spread would be the width of the spread minus the premium that you receive. Right. So that would be $5 minus 70 cents. So your total, your max loss would be $4.30. And that's why this is so risky when we understand that risk. $4.30. Translated to real money, that's $430. And remember, you have got 5 contracts. 5 contracts. So 5 times 430 would put you at a total exposure of $21.50. That's the risk. That's what Michelle is trying to avoid here. So instead of risking that $21.50, and the way that would come about is if it expired in the money, instead of expiring worthless, then what if I propose to you, let's do a 1x stop loss. So here's that looks. We're going to, and by the way, I think we can do 14 now here. All right, so we're going to go with, well, maybe a little bit more. I'm going to go with the 50, 55. Let's pick up $1.05. Actually, let's pick up 70. Just for this example here, let's assume we're going to go for 70 cents. And this is the 50, 55. Actually, we saw the IV puts us right here. Let's adjust a little bit here. Let's go with this, Michelle. How about that? The 55.60 for 90 cents. Okay.
Okay.
And your total exposure here is $4.10. The way we come about with that is the 5, which is the width of the spread, minus 90 or 0.9, and that gives you 410. And so your maximum loss here would be $410. If we push confirm and send just to let Thinkorswim do it for us, we can see the 410 is what that exposure is. That's the max loss. And if you're doing 5, like you said, that would be 410 times 5. What does that give us? That gives about 2,050. And that's about right. Yeah, max loss would be 2,050. So we want to mitigate that loss. Here's how we do it. A 1x loss says that if I'm expecting to make the profit of 450, then I want to risk 450. That's the theory behind it. So let's put our pain point at exactly equal to the amount that we are receiving in profit if we do profit. Right? Good deal.
Okay.
So would $450 destabilize your account? You have to first answer that question before you even enter the trade. Would that destabilize your account?
I would be good with that.
You'd be okay. So the answer would be no, it would not destabilize your account, right?
Right.
And the reason we're evaluating that is because you never want to enter a trade where the loss that you could possibly experience is going to, mess up your account. If it's going to mess up your account, then it's a bad deal. Don't do it. Right? So here's what we're going to do. We're going to make this into an OCO order. And the way I'm going to do that is through fast triggers OCO. I'm going to push right click and I'm going to create 2 additional orders. Yeah, 2 additional orders, one for take profit and one for stop loss. Right, one for take profit, one for stop loss. So I'm going to create, in order to close this position, in order to close it, I have to do the opposite of what I did. So I'm going to create opposite order. Notice that now it's green and this is a debit. And I'm going to push that again, make that a duplicate, and we'll talk about that in a second. So we're collecting 90 cents up front. And within an hour, we want to buy it back for 20 cents. Right? Or however much we can get, 20 cents. So our net profit on that would be the difference between 90 and 20, which is 70. And then you just multiply that by 5. So that would be what? 70 times 5 is 350. Yeah? Not a bad deal. Now, on our stop loss, I want to change these, by the way, to make it stop. This is the stop loss order here. And we're going to say, I'm going to ask you some questions now, Michelle. We understand the value of this spread. The maximum value is 5. We are selling high, buying low. So you're selling it for 90 cents. So what if the value of this spread is now, say, 50 cents? What do you think? Are you making money or are you losing money?
Making.
You're making. So so far you are at 40 cents in the green. Yeah.
Mm-hmm. Mm-hmm.
And in the other direction, say the value hypothetically of the spread is now $1.10. So at that point, you are off by about 20 cents, meaning that you're 20 cents in the red, correct?
Right.
Spread. So you're about $100 in the red. So at which point will it be that we are risking the whole 90 cents? Could we simply say it's 90 cents times 2? Well, let's see how that works. Yeah. Let's go with 1.8. Actually, 1.8. So at $1.80, if we got stopped out at $1.80, how would that translate? Let's do the math on this. It means that because we sold this spread for 90 cents, and now things are going against us, and we decide we're going to do a 1x. So 1x would be 2 times the premium that you received. At this particular point, if you buy this spread back at $1.80, it simply means that you're going to give back the 90 cents that you originally received. And additionally, you're going to give another 90 cents. So your net loss will be 90 cents for each spread. Are you there with me there, Michelle?
I'm processing it.
You got it. You got it. All right. So that would be my stop loss at $1.80, and which we call that a 1x stop loss, meaning that I received 90 cents. I'm going to risk that whole 90 cents because if I don't, the alternative is that I could possibly lose $2,050.
Yeah.
Yeah. But here we're capping our loss to 450, the exact amount that we received. So if you give me 450, I'm I'm going to say that, okay, I expect that I could potentially earn that whole 450. If not, then I will just lose 450.
Okay,
Yeah.
I got that.
All right. So yeah, the stop loss is not that bad. Yeah, just put it on 1x, and what that buys you is freedom of you get the freedom that it's not, if it does go against you, here's your cap. This is how much
Right.
you stand to lose. And so you don't have to be at your computer all day long.
Got it.
Because even if you're in front of your computer, your internet could go out, right?
Well, yeah.
Has that happened ever before?
No, it hasn't. I know it's a
but
possibility.
but
It's a
there's a
real.
possibility, right?
Yeah, yeah.
And sometimes the internet goes out and you don't even know it.
Mm-hmm.
Yeah, because you're
Okay.
looking at it and the numbers are not changing. But the idea here is
I
that,
think I'm going to paper trade this. I'm going to paper trade and try this Monday.
yeah, you should. You definitely should. So, lessons here are that, for one, you need a take profit. So you need to decide what your minimum profit is based on what's going on. That's number one. Number two, you do need a stop loss, and define what that stop loss looks like. And then the other thing is, if you look at the stop loss and the maximum loss and see that even with the stop loss, your account you just can't handle that, or you don't want to handle that, then maybe the position size is too big.
Mm-hmm.
It is too big. So if you were used to maybe selling 5, then you might consider going down to, say, 3, right?
Okay.
You might just decide, let's do 3 instead. And then that way the loss is not that great. In this particular scenario, 90 times 3 would be $270 exposure, right?
Yeah.
90 times 3. The profit obviously goes down a little bit. It's 90 minus 20, which is 70, and then times 3. So you'd be looking at about $210. Much better than the $30 that we were talking about earlier before we started, right?
Right.
Yeah. And this is a better way. And if you have to do this, because this is 0 DTE, it means that you're going to use up 1 day trade, right?
I have a cash account.
Okay. If you have a cash account that allows you to do a spread, then yeah, you're okay. You're not worried about this.
Yeah.
Yeah.
So I only trade SPX. So
okay,
you can trade that with a cash account.
yeah. And you're one of the few people who have a cash account that can also do spreads inside the cash account, because usually this requires margin.
Yeah, exactly.
Yeah. So but I understand. I do have a cash account as well that allows me to do this kind of spread. But that's because I've been with this company for a very long time.
Okay.
Yeah. The people who are opening up accounts in the last few years cannot do spreads inside of a cash account. So let's be clear with that. If you just open a TD Ameritrade account, or and it's cash, then no, you cannot do spreads. You can do calls and puts, you can do cash secured, but you cannot do verticals. So this kind of trade does require margin. Not that you're using margin anywhere, but it just requires an account of type margin. Hey, that's the good intel over there for you, Michelle.
Yep, this is great. I was gonna quit and close my TradeStation account and just put my money in a high yield savings account, because I figured that would be better than what I'm doing. But I'll go ahead and paper trade this next week and see how I do, and maybe I won't quit.
Yeah. And you mentioned a high yield savings account. That is still a good idea to put some of your money in there. And for my students, when they're fresh and new coming in and they have a lot of money, I usually tell them that even if you have $100,000 coming in, don't put it all in the stock market. Instead, start off with about $3,000 to $5,000. Learn how to make that grow and multiply it before you put in any money. And you're going to realize that if you learn how to make that $3,000 to $5,000, start growing by doubling and growing, consistently, you will discover you don't need to bring the rest of the $90,000 from wherever it is. So these days, high yield savings accounts are doing what, 5%?
Yeah.
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 I know a few places that are actually doing 5.25%. And anything over 4%, let's put it that way, is really good, because I don't know, let's do some simple math over here. 100,000 times 4, and let's just average it to about 4.5%. Yeah, that would be about $4,500. That's the APY, assuming the APY is 4.5%. So there's a difference between APY and the interest rate, the actual interest rate. Are you familiar with what is APY and APR?
No, not really.
No? Okay, well, a lot of people don't, so no big deal. The APY is the annual percentage yield. So that's the straight amount. If you were to just put in the 100,000 and multiply it at 4.5, that would be the simple interest way of doing it. Yeah, okay. There's a simple interest. That's what you would get, 4,500. The APR, which is usually lower than the APY, is the number that you use for compounding interest, right? So let's say you have that 100,000 invested inside of your high yield savings account, and it is compounded monthly, meaning that whatever interest has been accumulated in that 1 month, it is now capitalized, right? Let's do an example here. If let's say we have an not 80, but APR, annual percentage rate of say 4.4%. I know these are big numbers. On 100,000, that would be 4.4%. That would be 4,400 divided by 12, because it's being compounded every month. So you get about $366. So your new capital at the end of the month is $100,366. And so next month, you get a slightly bigger interest or return on your money. That's why you've got two different numbers there, APR and APY. But a lot of people just concentrate on the APY for straight line calculation and decide that's to estimate approximately how much your money would earn at the end of the year. So it's going to be, even though it's 4.5% of 100,000 is 4,500, you'd actually earn a bit more than that, and you'd wonder why. It's because of the compounding every month. Yeah, good to know.
Yes,
good to know. So yeah, the next time you go to your bank and you're talking about a high yield savings account, ask them what the ATR and the APR and the APY is, and you will get a bit more respect from them, right?
Got it. Thanks, Eddie. Very helpful. Lots of nuggets this morning. I appreciate it.
Not a problem. Not a problem. Let's see. What's up, Mary? Hey, Mary, how you doing?
Hi, Eddie. I'm great.
Awesome. Awesome. I wouldn't take anything less from you. Got to be great.
Totally.
Yeah. Yep. All right. Got a light crowd this morning, but that's okay. That's cool. Yeah, just talking about general things. If you have questions, put them out there. We'll see what we can do about that. And yeah. So I take it you guys are still on Think or Swim. Is that right?
Yes.
Yeah.
Eddie, based on your conversation a few minutes ago, are you anticipating that the market will continue to go down?
I think there's room to go down. There is room to go down based on what's happening around socioeconomically. But knowing S&P, I also understand that it could change direction. But I think if history were to repeat itself, I think we'll go down a little bit before we turn around. So usually my bias is built at 9:30 in the morning, or 9:15, 9:30 in the morning. That's when my bias is usually built. Because I look and see what overnight activity has presented itself and how things are looking. We're sitting at support, two key support levels, right? So we've got a double bottom here. We can consider this the first bottom. Would you see that? Let me
Yes.
bring up my fancy tool. Right. So this is the first the first V that I see right here, and then the second one, which is over here. And what do we know about a double bottom? We know that if we break the double bottom, we tend to do what?
Continue down.
That's there. There you go.
And so the next resistance is at about, I'm having difficulty seeing your numbers.
It's
yes.
right about here. It's
okay.
42.50, which is let me tell you how many points that is. 43.20. That's about 70 points, give or take.
Okay.
So yeah, if we were to read the charts the normal way that everybody reads them, is we look for these double bottoms or the mountain tops. Right now we've got a double bottom. We've broken the double bottom. That means that we broke support with yesterday's candle. We tested it on Thursday. On Friday we broke it, and this was decisive, right? You notice that the wick is longer at the top than at the bottom.
Yes.
So we have a bigger bottom, a bigger body at the bottom than at the top. That is a bearish candle. This one is just bearish. This one is also bearish. This one is more bullish. This one is bearish, even if it's green, because you can see the wick pushed everything down. So the point here is that once we break that double bottom, the tendency is for continuation, unless something in the market changes. Then I fully expect it to go downwards. If it does, then it will be a very strong move, because we have a really nice gap over here, right? We have a really nice gap over here that traders like trading gaps, because we know that we tend to want to fill them completely, but lately we've been having trouble filling gaps on the first day. Yeah. So hopefully that says something.
It does. Thank you.
Sure. Mm-hmm. Yep. So Patrice is saying she has okay, yeah, cool. Yep. Double bottoms or double mountain tops. Yeah, that's a thing. If you learn these patterns, then that usually helps in your trading, especially when you're doing actually any kind of trading. You got to know the patterns that determine how price is likely to move. Yeah, I should add that caveat and say that we're not saying that for sure this is what's going to happen. It's just that a higher percentage of the time, that is what price action has done. So a good place to go find out is the Candlestick Bible, or any other place just like it. It's a quick read. It's got lots of pictures, lots of explanations. You don't have to read the whole 300 pages. But yeah, you want to know a few of these important formations. So this is a candle formation that you should know and you should learn. Okay. What's up, Clarence? You went to the bank yesterday?
No, I didn't do anything yesterday.
Okay. Yesterday was Friday, man. You're becoming like Eddie.
No, I had errands to run.
Okay. Yeah, I don't trade Fridays also. Just out of choice, by the way. Nothing special about Fridays. Yep. Very cool. All right. Well, it's going to be a short Saturday. Any other, anybody else got questions? Let's see. I thought I saw Obi a few seconds ago. He's dropped off. Okay. Patrice, what's happening, Patrice? Good morning. Sound like you're in Canada.
No, no, I'm just learning. I actually, I have read the Candlestick Bible, but I think I need to go reread it and see, these other patterns like a double bottom.
Yeah, I think your mic is blocked.
Oh, can you hear me better now?
Oh yes, there we go.
Okay, yeah, I said I think I need to go reread the Candlestick Bible because I can't recall seeing that. Other things I've seen, but I can't recall seeing that. So I need to go refresh on that.
Okay, yeah. Look up the double bottom. Look up the double mountaintop. Look at the bull flag. Look at the bear flag. Those four formations present themselves very, very often, and they help guide us in determining, how price action might behave. So, yeah, very cool. All right, guys. Well, today is Saturday. We'll see you here in a couple of weeks. And if you have any questions, by all means, reach out to me. And the best way to do that is going to Options with Eddie. That's the absolute best way to get a hold of me. Optionswitheddie.com. Hopefully you can see that.
Yeah,
And yes.
Yeah, before you take off, my option chain is starting out at October 20th. Is there a reason why that will be?
For S&P?
Yeah. Well, for everything.
For everything. Okay. And this is on live or this is on?
This was on live.
On live. Well, Saturdays, we know for a fact that Thinkorswim does its maintenance on Saturdays. In fact, the first thing that you see when you open Thinkorswim is they tell you that there's maintenance. At least for me, that's what happens if I do it on Saturday. So it could be a maintenance issue.
Yeah, the first one is October 20th.
Okay.
And they're all AM.
Okay, and they are all AM. So another setting that probably could be tripping you is, let's see, display. You maybe have that unchecked.
Where we at?
So you're saying that your view looks like this, yeah?
No, I'm not seeing your screen now. Where we at? Where's your screen?
Anybody else see
Yes,
screen?
I see your screen.
Yeah.
Okay. So you're saying your screen looks like this?
Yes.
Okay. Yeah. So go to the top right.
Okay.
Where it says setup.
Okay.
Push application settings.
Got you.
And on the left side, go ahead and push display.
Okay.
And then on the right side, make sure that this box is checked. The one that says non-standard options for weeklies and quarterlies.
Okay.
Push apply settings.
And that should get. Okay.
Is that working?
No, I haven't done it. I have to log on.
Clarence, the whole time you're offline? Just kidding. All right. Yeah, just do that and it should work.
Application, display.
Yep.
That one.
Looking better?
Yeah.
Very nice. Very nice. All right.
All right.
Yep. So yeah, probably a setting that got unset. I don't know how that happened, but
yeah.
Okay. All right, good deal. So yeah, just to repeat myself again over here, for those looking to contact me or get into my program, then this is a really, really nice way to learn what we're doing. Options with Eddie, we're going to teach you how to get consistent income regardless of how the market looks like, up, down, sideways, upside down, whatever way. That's what we want to figure out how to do. It is a process. It's not an overnight deal. So we don't expect that you're going to make thousands of dollars in a very short space of time. This is a very disciplined approach. So go over there, learn what I'm doing. That's the format right now. We're doing 2 times a week for 4 weeks, and that's on Mondays and Wednesdays. Okay, Mondays and Wednesdays. And if you want to discover what this is all about, just set up a quick meeting with me by pushing the quick meeting button up here. Schedule about 20 minutes, and let's discover whether this is for us, right? And then once you're ready, go and push pricing and sign up. Follow the instructions there, and we'll get together. So, any questions today about that? All right, good deal. Well, wishing everyone a happy Saturday, and we will see you in a couple of weeks.
All right.
Thanks, Eddie.
All right. Bye-bye.
Thank you, Eddie.
Bye.